Most investors walk into a financial advisor's office or open an online account and immediately get handed a risk tolerance questionnaire. You answer 10 questions about how you'd feel if the market dropped 20%, whether you prefer steady returns or big gains, and how you'd react to watching your portfolio lose value. The questionnaire spits out a score, and suddenly you're labeled as aggressive, moderate, or conservative. Here's the problem. That score is only telling half the story. According to Morningstar research, approximately 68% of U.S. investors believe they have a high or moderate risk tolerance. But when tested with scenario-based questions, only 41% actually demonstrate sufficient risk capacity for their stated goals. What happens when you're emotionally comfortable with volatility, but financially can't afford to take the risk? Or when you're nervous about market swings, but actually have the financial capacity to weather them? In today's video, I'm going to reveal why your risk tolerance score is incomplete and why ignoring something called risk capacity is causing devastating portfolio mismatches that derail retirement plans. I've spent 3 decades in investment research, and I've seen too many investors build portfolios based on how they feel rather than what they can actually afford. Let's fix that. Chapter 1, Understanding Risk Tolerance, the psychological side. Let's start with what most people already know about. Risk tolerance is your emotional comfort with market volatility and investment losses. It's psychological. According to studies, risk tolerance measures a person's subjective comfort level with market volatility and potential loss. It reflects how you feel when you see your portfolio drop 10%, 20%, or even 30%. Think about it this way. When the market crashed in March 2020 and dropped over 30% in just a few weeks, how did you react? Did you panic and want to sell everything? Did you feel anxious but stayed the course? Or were you actually excited about the opportunity to buy more at lower prices? That emotional reaction is your risk tolerance. Risk tolerance is shaped by your personality, your past experiences with money, and even recent market news. One study describes risk tolerance as a state of mind that can fluctuate wildly in response to the market. Someone who felt aggressive and confident during a bull market might suddenly feel conservative after experiencing their first major downturn. Here's what's important. Most brokerage firms and financial advisors use risk tolerance questionnaires as their primary tool for portfolio construction. You answer questions like, if your portfolio lost 25% of its value in 1 month, would you A, sell everything, B, sell some, C, hold steady, or D, buy more? Based on your answers, you get assigned a risk score and matched to a model portfolio. But this approach has a fundamental flaw. It assumes that how you feel about risk is the same as how much risk you can actually afford to take. And that's where risk capacity comes in. Chapter 2, Understanding Risk Capacity, the mathematical reality. Risk capacity is completely different from risk tolerance. According to certain studies, risk capacity refers to the objective ability to absorb losses based on income, assets, time horizon, and financial goals. It's not about feelings. It's about mathematics and financial reality. To put it clearly, risk capacity is your objective ability to take on and recover from losses without jeopardizing your financial goals. This is based on hard numbers. Your net worth, your income, your expenses, your time horizon until retirement, and your future cash flow needs. Let me give you a hypothetical scenario to illustrate this. Imagine someone who just sold their business for $3 million. They're 45 years old, have no debt, earn $200,000 a year from consulting work, and won't need to touch their investment portfolio for another 20 years. This person has extremely high risk capacity. They can afford to have 100% of their portfolio in stocks because even if the market drops by 50%, they have time to recover and they don't need the money for decades. Now imagine a different scenario. Someone who's 64 years old, planning to retire next year, has $800,000 saved, and will need to start drawing $50,000 per year from their portfolio to supplement Social Security. This person has low risk capacity. Even if they feel emotionally comfortable with volatility, they cannot afford to take significant risk because they don't have time to recover from a major market downturn before they need to start withdrawing money. According to the Portfolio Construction Forum, for most investors, financial risk capacity can be described as whether an investment strategy will meet their cash flow requirements. It's a financial concept, not an emotional one. Chapter 3, the critical difference between tolerance and capacity. Here's where we need to understand the fundamental difference. Risk tolerance is psychological. It's about comfort and emotions. Risk capacity is mathematical. It's about financial ability and constraints. One study I read makes this distinction crystal clear. Risk tolerance is a state of mind and can fluctuate wildly in response to the market. Risk capacity, on the other hand, is fixed. Your goals have an end date, and your financial situation determines how much risk you can actually take. The problem is that these two factors don't always align, and when they diverge, investors run into serious trouble. According to research, when risk capacity and tolerance diverge, investors experience greater regret, panic selling, and poor decision-making under stress. Let me show you what happens when these factors conflict. The 2008 financial crisis provides a perfect real-world example. Many pre-retirees had aggressive portfolios because their risk tolerance questionnaires indicated they were comfortable with volatility. But when the market dropped 57% from peak to trough, many of these investors had low risk capacity. They were close to retirement and needed their money soon. According to Morningstar, these investors were forced to sell assets at depressed prices during the crisis, locking in losses and undermining their retirement security. The consequences are measurable. Retirement shortfalls where required withdrawals exceed portfolio value, forced selling during downturns when liquidity is needed for expenses, and permanent depletion of capital that reduces standard of living. Chapter 4, Real-World Example. The confident investor who can't afford the risk. Let me walk you through a hypothetical scenario that illustrates this perfectly. Consider someone who's 62 years old and planning to retire in 3 years at age 65. They've been investing for decades, lived through multiple market cycles, and are not afraid of volatility. They fill out a risk tolerance questionnaire and score is aggressive. They genuinely feel comfortable with market swings. Based on their risk tolerance score alone, they might be placed in a portfolio that's 80% stocks and 20% bonds. On paper, this looks appropriate for their comfort level. But now, let's look at their risk capacity. They have $600,000 saved for retirement. They'll need to draw $45,000 a year from this portfolio starting in 3 years to supplement their Social Security income. They have no pension, limited other assets, and this $600,000 needs to last them 25 to 30 years. Here's the problem. They have high risk tolerance, but low risk capacity. According to portfolio theory research, clients with shorter time horizons face greater risk of capital depletion and should shift allocation to bonds and cash to reduce volatility. What happens if we ignore their capacity and build based on tolerance alone? Let's say they retire in 3 years with that 80% stock portfolio and the market enters a bear market right as they start withdrawing money. Historical data shows that the S&P 500's average recovery period for major downturns is about 4 to 5 years. During the 2007 to 2009 financial crisis, stocks took about 4 years to recover from previous highs. If this investor is forced to withdraw $45,000 per year while their portfolio is down 40%, they're selling shares at depressed prices. This is called sequence of returns risk, and it can be devastating. They might run out of money 10 to 15 years into retirement instead of making it last 25 to 30 years. This is a hypothetical example for illustration purposes, but I've seen variations of this scenario play out many times over my career. The correct approach would be to prioritize their risk capacity over their risk tolerance, even though it feels counterintuitive. Chapter 5, Real-World Example. the nervous investor sitting on cash. Now let's look at the opposite scenario. Imagine someone who's 45 years old with a great career, earning $180,000 per year with strong job security. They have $400,000 saved, no debt except a modest mortgage, and they won't need to touch their retirement savings for another 20 years. When they fill out a risk tolerance questionnaire, they score as conservative. They remember watching their parents stress about money during the 2008 crisis. They hate seeing their account balance drop. Every market correction makes them anxious. Based on their risk tolerance alone, they might be placed in a portfolio that's 40% stocks and 60% bonds or cash. They feel comfortable with this allocation because it doesn't fluctuate much. But here's what we're missing. This investor has extremely high risk capacity. They have 20 years until retirement, stable income, minimal debt, and healthy savings. According to portfolio theory, investors with long time horizons have higher capacity for risk because they can withstand market downturns and allow more time for recovery and compounding. By keeping 60% in bonds and cash, this investor is actually taking on a different kind of risk, the risk of not growing their wealth enough to meet their retirement goals. Over 20 years, the difference between a conservative portfolio and a moderately aggressive portfolio can be hundreds of thousands of dollars. This is another hypothetical example for illustration purposes. The right approach here is to educate this investor about their capacity and help them understand their financial situation allows them to take more risk than they're comfortable with emotionally. We might gradually increase their stock allocation while implementing strategies to make them more comfortable with volatility, like automatic rebalancing, focusing on long-term goals, and avoiding constant portfolio monitoring. Chapter 6, How Risk Tolerance and Risk Capacity Change from age 40 to age 75. One of the most important things to understand is that both risk tolerance and risk capacity evolve throughout your life, but they change in different ways and for different reasons. Let's start with ages 40 to 55. According to one study, during these peak earning years, risk capacity often remains relatively high because you're earning good income and have time before retirement. However, major obligations like mortgages and college savings may constrain your capacity. Your risk tolerance during this period is typically moderate. Most investors start shifting from aggressive growth strategies to more balanced portfolios as they can see retirement on the horizon. From ages 56 to 65, things start to change more dramatically. Your risk capacity begins to decline as retirement approaches and your time horizon shortens. You have less time to recover from major market downturns. According to research from Morningstar, most investors also show a drop in risk tolerance during this period, favoring capital preservation over growth. Then comes ages 66 to 75 and beyond. Both risk capacity and risk tolerance generally decrease further during this stage. Your risk capacity is now defined by the need to preserve principal and provide income. You're withdrawing money from your portfolio regularly, which means market volatility has real, immediate consequences on your lifestyle. According to 2025 survey data, 78% of investors aged 65 to 75 prioritized stability and were allocated more than 60% to bonds and cash. Here's what's interesting. These two factors don't always move in sync. You might maintain high risk tolerance into your 60s because you're experienced with markets and don't panic easily, but your risk capacity has decreased because you're now dependent on portfolio withdrawals for income. Or you might become more risk averse as you age, even though you actually have high capacity because you have substantial assets and minimal spending needs. The key insight is this. Your risk capacity should always take priority over your risk tolerance when these factors conflict. Capacity is based on objective financial reality, while tolerance is based on subjective emotional response. Chapter 7, The Divergence Problem. when tolerance and capacity don't match. So what do you do when your risk tolerance and risk capacity don't align? This is one of the most common challenges in financial planning, and it requires a thoughtful, strategic approach. First, understand that this misalignment is extremely common. According to Moore's 2024 investor survey, when tested with scenario-based questions, a significant portion of investors demonstrate a mismatch between their stated tolerance and their actual capacity. You're not alone if you're facing this. When there's a conflict, portfolio construction should always prioritize risk capacity over risk tolerance. According to research from Oxford University Press on portfolio theory and management, it is necessary to separate risk tolerance from risk capacity to be consistent with standard normative analysis based on expected utility models. In plain English, your portfolio should be built on financial reality, not just emotional comfort. Here's a practical example. If you have high risk tolerance but low risk capacity, like our 62-year-old approaching retirement, your portfolio should be more conservative than your comfort level suggests. This might mean holding 50% in stocks instead of 80%, even though you feel you could handle more volatility. The math matters more than the feelings. On the flip side, if you have low risk tolerance but high risk capacity, like our 45-year-old with 20 years to retirement, you need a different approach. Rather than simply building a conservative portfolio that matches your emotions, we need to address the tolerance issue through education and portfolio structure. Chapter 8, How We Solve Mismatches, Prioritizing Capacity with Education. This is where comprehensive financial planning makes all the difference. When someone has high capacity but low tolerance, we can't just force them into an aggressive portfolio and hope they stick with it. That's a recipe for panic selling at the worst possible time. Morningstar research shows that investors who trade more frequently perform worse, often due to emotional reactions during downturns. Instead, we use several strategies to help align behavior with capacity. First, we use cash flow modeling and scenario testing to show clients exactly how different allocation strategies will affect their long-term goals. When you can see that a conservative portfolio might leave you $500,000 short of your retirement needs, while a moderate portfolio gets you there comfortably, it changes the conversation. Second, we implement portfolio structures that make volatility more manageable psychologically. This might include a bucket strategy, where short-term needs are covered by cash and bonds, while longer-term growth comes from stocks. According to the Portfolio Construction Forum, this approach addresses whether an investment strategy will meet cash flow requirements while still maintaining growth potential. Third, we focus on automatic rebalancing and systematic investing. These strategies remove emotional decision-making from the equation. You're not constantly evaluating whether to buy or sell based on market conditions. You're following a predetermined plan. Fourth, we educate clients about market history and recovery periods. Understanding that stocks take about 4.5 years to recover after the 2007 to 2009 crisis, but only 6 months after the COVID-19 crash in 2020, helps put volatility in perspective. When you have 20 years until retirement, a 4-year recovery period is manageable. When you have 3 years until retirement, it's not. The key is that we're not ignoring risk tolerance. We're addressing it while still prioritizing capacity. We're building a portfolio that matches financial reality while making adjustments to help the investor stay committed to the strategy. For someone with high tolerance but low capacity, the approach is more straightforward but often harder psychologically. We need to have honest conversations about the consequences of taking too much risk. I show them scenario analyses of what happens if they need to withdraw money during a bear market. I walk them through examples like the 2008 crisis, where investors with insufficient capacity were forced to sell at the worst times. This is where my experience as a 3-decade investment research veteran comes in. I've seen multiple market cycles. I've watched investors make these mistakes in real time. And I've helped many people build portfolios that honor both their financial reality and their emotional need, always with capacity as the foundation. If you're watching this video and realizing that your current portfolio might be based primarily on a risk tolerance questionnaire rather than a comprehensive assessment of your risk capacity, it's time to take action. The difference between getting this right and getting it wrong can literally be hundreds of thousands of dollars over your lifetime, or the difference between a comfortable retirement and running out of money. At Upstream Investment Partners, we specialize in constructing comprehensive financial plans for mass affluent investors that go far beyond simple risk tolerance questionnaires. We analyze your complete financial picture, your income, assets, time horizon, cash flow needs, and goals to build portfolios that match your actual risk capacity while respecting your risk tolerance. We've helped many investors avoid the devastating portfolio mismatches I've described in this video. If you'd like to schedule a call with us to review your current portfolio and see whether your asset allocation matches your risk capacity, visit our website or reach out to us directly. We offer comprehensive financial planning that covers all 4 pillars of financial success: your financial plan, wealth management, insurance and protection strategies, and estate planning. And if you found this video valuable, please subscribe to this channel for more insights on investment strategy, retirement planning, and wealth management. Share this video with anyone you know who might be making investment decisions based solely on how they feel about risk rather than what they can actually afford. Understand the difference between risk tolerance and risk capacity is one of the most important concepts in successful investing, and it's something that too many investors and even advisors get wrong.